So the big question is this: how are those in the self-storage industry like us going to be successful in today's market? That's the question, and this show will give you the answers. My name is Jim Ross, and welcome to the Self-Storage Show.
Hi, everyone. It's Jim Ross again from the Self Storage Summit. Again, thanks so much for joining us here on the first day. This is going to be a very important topic, and I was thinking about coming finding a topic for investing strategies and all that for storage. Well, of course, Kris, you came to mind. So, Kris Bennett joining me here. Thanks so much.
Thank you, Jim. Appreciate it.
Yeah, it's nice to have someone else that's doing the content out there as well and doing the videos and everything else. So this is right up your alley, doing something like this.
Yeah, it's a lot of fun, actually. I really enjoy it. And you get a lot of traction with it too. I think more and more people should do it. So it's kind of tough to start, but you kind of got to get over yourself. I think you kind of get in your own way.
Yep.
But once you get going, it gets easier and easier.
No, this is perfect. Like I said, when I was coming up with this idea of putting the summit together, I'm like, okay, I had to reach out to Kris to do something because I knew you'd be game, you'd be professional at it. So cool. This would be a great topic. So let's just roll right into it and kind of tell us a little about yourself, how you got into it, and we'll get into your presentation.
Awesome. That sounds great. I got my real estate license. Well, I'm Kris. Nice to meet everybody who's on this episode or stream. I got my license in 2007, right before the Great Recession. So I had no idea what was coming. We had about 300 people in my licensing class. We're all going to be Grant Cardone, Ryan Serhant millionaires in like 10 years. But that obviously didn't play out the way that we all expected. So 2008 hit, and it was pretty tough. I slugged it out in the real estate and residential for about 3-ish, something like that, years. They're all kind of a blur at this point in time. But I decided to go to school and kind of up my education game a little bit. So I went to UNC Chapel Hill. They have a private equity real estate fund there. Interesting enough, I wasn't going to go for real estate. I actually had kind of a bad taste in my mouth because of all the how hard it was during the recession. Yeah. But I didn't see the opportunity that was there. So, had I had a different lens, I think I would have seen it differently. However, I went to school to focus on economics and some other things. Interesting enough, the only internship I could find my first year there was in a real estate private equity group there in Chapel Hill that bought and renovated apartments. So I had no idea anything about that side of the business, but fast forward, I learned a ton during my time in school. I graduated, worked with a family office up in the Raleigh area. Then I moved back to Charlotte, which is where I live right now with a wife and family, and doing the same thing, looking for self-storage deals. And we look at some other things as well that's kind of interesting out there. I'm actually just launching, by the time this goes live and people are watching, then go to our website, Cornerstone Capital is the name of the group. Starting with a friend of mine. His name is John. You'll see the bio and everything there if you guys visit that website. But we're looking for self-storage deals to acquire and build a portfolio, and obviously go from there, refi or sell, and then move up. So that's the plan. That's where I've been, and here's where I am right now, presenting to your audience. I really hope that folks get value out of this. I put my best foot forward. If anything is confusing or whatever, please, Jim, jump right in, ask questions. That's totally fine. But I'll try and zip through. Won't take people's time, take up too much time. If anybody has questions at the end, please visit our website, shoot me an email, visit the YouTube channel. There'll be more interviews as we go along. And my YouTube channel is basically about interviews and self-storage. And I talk to folks who are experts in the industry and try and get that information out there. So let's go ahead and jump right into it, guys. So the topics I plan on covering in this brief time that we have is why self-storage is hot, where the industry is right now in the cycle, acquisitions strategies, and then the acquisitions mindset. And I think that part is the most important because it can get kind of discouraging out there considering how hot, how hot the market is right now. So let's go ahead and jump right into that first topic. So a lot of people who've been around the industry probably know some of this stuff, but for those who are new, a lot of the reasons why people jump in are listed right here. The most pertinent being the fragmented ownership. So if you look at self-storage, let's call it 75-ish% of all the facilities out there in the US. Let's say there's 45,000, 50,000 facilities now. About 75% of those are owned by mom and pops that own just maybe one or maybe two facilities. So the rest of them are owned by the REITs, the regional players, et cetera. So there's an opportunity to build a portfolio or to acquire one or two of your own if you're looking to do that, and you'll be pretty set. The rest of it there are pretty self-explanatory. It's an easy to understand asset class. You're kind of just written, almost like garages in a sense. We're not splitting atoms here, as somebody said once. So it's pretty straightforward. I'm not saying it's easy to do or to manage, but it is easy to understand the business plan. And then it's recession resistant. And I want to jump into that and talk about what we mean by that. So people say it's recession resistant, performed well during the last recession. Well, let's kind of see how that looks. So I pulled these returns off of NAREIT, NAREIT, and go to that website, and that tracks all the returns, total returns and values of the publicly traded REITs out there, and then of course the returns of the S&P 500 since 2008. And you can kind of look over this chart, this table as we're going through this, but you can see in 2008. I think my pointer here, yeah, in 2008, obviously S&P 500, apartments, and storage. So storage was positive during that recession and obviously positive going forward. Now we had a big bounce back here, but you look all the way through this on average, this is just a general average. It's not a CAGR, which is what some people call it. It's not geometric compounding, that sort of thing. It's just an average of these numbers in the columns, okay? So your average return on storage, give or take 16%, something like that. The point is, it was better than apartments over this last 10-year period, better than the S&P 500 over the last 10-year period. So, and if I invested $1 in self-storage, S&P 500, or apartments, this is what I would end up with over that same period. So let's jump to the next one. So you can see here, I've highlighted during the recession, storage performed well. And then there's some trade-offs going forward. Some apartments did better in 2010, it kind of go back and forth a little bit here. But again, that dollar, if I invested $1 back in 2008, that's what I would end up with on average. Again, not compounding or anything like that, just kind of simple math here. So that's what people mean when they say, okay, it's recession resistant. It performed well during the last recession. Okay, if I'm looking for a risk-adjusted return, I'm an investor considering what I'm going to invest in as far as real estate is concerned. Everybody kind of points to this. And the SBA, they point back to this as well, and they say, okay, during the last recession, storage performed well. In 2010 or 11, I think it was, you had the Live Oak Bank folks on, Terry was on, I know that. So, they decided, okay, the SBA decided that we'll go ahead and back self-storage as an actual business. So that means the SBA, the government, actually looks at self-storage in the same way that you might look at a nail salon, a car mechanic, or auto body shop or whatever. They'll make loans to those type of businesses. We'll also make loans to self-storage investors or owners, because we see it the same way as far as risk return is concerned. So that says a lot about the industry, and that's generally what people are talking. This is generally what people are talking about when they say it's recession resistant. And obviously there's the math there. So the key takeaway, again, I wanted to make sure there's an image here for people to remember. It's strong. Recession-resistant asset class provides solid returns over the long run for investors. There are some trade-offs, with self-storage. There are some cons with self-storage that you want to be aware of. I have a video of that on my YouTube channel. You can check that out. It's not the greatest thing ever. The greatest thing, I think, is the investment that but self-storage is very strong as far as your real estate investment asset class. So, all right. So we just covered, why storage is hot. Let's jump into the recession resistant, obviously, and then let's jump into where the industry is in this current cycle. So you might have been driving around. You've probably seen it pop up all over the place. And I laugh because I was, one time I was picked up by an Uber driver, literally like in a pickup truck. He doesn't know anything about real estate or whatever. We're just chatting away. I told him what I did. And he said, do we need any more self-storage? And so I think that was a great question by him. And I said, probably not. I think in a lot of places. But if your Uber driver knows that it's all over the place, I'm sure that you as well know that it's everywhere. And you see all the concessions, 3 months free and all this stuff going on. That's the most I've seen one time in Cary by a group was 3 months free rent, which I thought was pretty astounding.
Pretty aggressive.
Yeah, this is in Cary, North Carolina. And this is probably a year or two ago. So hopefully they've done better. I don't really know because I know that another one was being built nearby that one. So anyway, Just to kind of to the point, okay, so I just picked out a random market, Pensacola, Florida. This line here is at the bottom. You can see it's about 5 miles. And so you can see all the almost all of these, maybe not this one, but almost all of these are within that 5-mile radius. Yeah. Pensacola is a pretty saturated market. I've seen some deals pop up on the market in Pensacola. I'm not saying that it's a bad market to invest in. I'm just saying that if you see the amount of storage everywhere, this is within, again, a 5-mile radius, all of these facilities. It's pretty staggering. Here's another one, Raleigh, North Carolina. This is where I used to live. This is on one stretch of road. Yep. This road is about 10 miles, a little less than 10 miles. And I think I counted it earlier. There's like 10, 12 facilities within on this one stretch of road. Yeah, and these aren't mom and pops. We got some here, but CubeSmart, Extra Space, Public, Red Carpet. This thing is actually huge. CubeSmart over here. Brassfield is pretty well known in this area. That's a big one. Another CubeSmart, Secure Care. Store Smart. This is on one road in Raleigh. So yeah, it's again, storage is everywhere. And to the point, I actually just came across this article this week.
Yep, I just October
29th. Yep. Yeah, October 29th. I posted it on LinkedIn. Towns to self-storage facilities. Please go someplace else. So,
I got my. Yep.
Yeah. You know what? And we're in the industry, and I love the industry, but I have to agree in some cases, that we're getting pretty aggressive, which is, it just you kind of have to realize that, okay, you can't build everywhere. We can't develop everywhere. We're going to run into some problems, and we'll jump into that here in a second. But growth this is from the article, growth in the storage industry, and as far as i.e. construction growth, which sagged during the recession, has soared, partly financed by yield-hungry investors. So let's look at what that looks like. So here is storage stockpiles. Spending on construction. So you can see here, obviously, we're kind of, even keel here, dipped after the recession, and then boom, 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 2016, 17, 18. So let's zoom in on that real quick. Okay, just a comparison. During the recession, 2008, construction costs are nearly 5 times last year.
Crazy.
So yeah, so it's just very, again, people realize, oh, okay, storage is getting hot. It's recession, quote unquote, recession resistant. It's easy to understand. There's opportunity to acquire. So people are jumping in. I just had a call the other week with a group, $1 billion investment company. We spent almost an hour on the phone talking about the self-storage industry because they're pretty much in almost every other asset class, and now they're trying to get into storage. So there are people who are aggressive with lower cost of capital, which we'll get into, that are targeting storage. Again, we'll look here. Okay, so storage did okay. This is that same table. Storage did okay during the recession, but why was that? Because we didn't have, construction going buck wild. Even during 2005, when residential was okay, was doing really well, there wasn't a ton of self-storage construction like there is now. So now look at the returns. According to what that article said, obviously yield-hungry investors are going out and developing, constructing more and more. 2018 did not look so well as far as overall total return of the self-storage REIT. Now this is REITs. Again, another caveat real quick. This is REITs, so it's not private deals, not private syndications. So the returns could look a little bit better in a private deal versus a publicly traded deal. Not always. Look at WeWork, but sometimes. So just a caveat. But just to be aware, kind of what's going on. So what do you have? You have prices going up because more and more groups are jumping in, but yields going down. It's simple math, supply and demand. There's little supply, high demand. So acquisition prices are going up, yields are coming down. So people are looking to development, groups are looking to develop because, okay, we can sell this deal in 2 or 3 years and make a really good return on it. But that all depends on what your pro forma looks like. You're probably projecting 3% rate increases, whereas that may not be there. A few points to keep in mind: acquisition is harder to find, risky development pipeline in a lot of places. I know of a portfolio that recently sold for under 5 cap. So that's very aggressive. And this is the kicker. October Yardi report, which you can go to Yardi Matrix and download that. Anybody can download that. Just give them your email or your information. You can download it. Rents down 2 to 4% year over year in major markets. They track out of, I think it was 85% of the major markets they track, rents were down 2 to 4% in 85% of those major markets. So again, it goes back to prices going up, yield coming down, and then just the amount of construction going on, at least right now. So 2019, I think, is going to be a little bit more than 2018 or pretty close to it. And then 2020 as well. So we're going to see, again, big bars. You know, this is not going to go away anytime soon. So, which is really astounding. So key takeaway for this point is more dollars chasing fewer deals, driven by a search for yield and a desire for recession-resistant investment. So you have investors looking in the real estate space, like that group I talked to, $1 billion group. They want to jump into storage. So just to be aware of that stuff. So we just covered, you know, where is the industry in this cycle. Let's jump into some acquisition strategies going forward. So this is actually kind of important to think about. And if you're trying to jump in, like that group trying to jump in, you got to understand where the market is, who are the players in each segment of the market, what their cost of capital is, and how you can compete against them for the same deals. Because a broker deal hits the market, I mean, it's, you know, everybody's jumping on it, and pretty much, yeah, exactly. And it's as one guy I know used to say, it's kind of jump ball. You know, whoever jumps the highest, whoever pays the most, wins the deal, wins the ball. So I like to think of the storage market as kind of bifurcated, and that just means divided. So generally, you have the larger groups that want 40,000 square feet and above, and you have the smaller groups that want 40,000 square feet and below. Now, this isn't like a hard and fast rule. Some would say it's maybe around 30,000 square feet, but somewhere around there. I just call it 40,000. And the reason for that is because your expenses, your manager, the personnel expense is generally your largest expense in the P&L. So if you're at 40,000 square feet and above, let's say your rents are $1 per foot, you're making pretty good income, and you can support a really good on-site staff, on-site manager. And then there's property management fees that generally speaking, they don't change for the most part. There's usually a minimum threshold on that, and then it kind of goes up as a function of, you know, gross potential rent, or actually effective rent. Anyway, the point is that the bigger you are, the more you can pay for better people, the better your facility can be run, usually, generally speaking, so that hopefully you'll capture more customers from that market. If you're under 40,000 square feet, you can't pay as much toward a really good manager, and you don't have as much cash flow at the very end. So that's what I'm saying. It kind of divides right there. Also, along primary and secondary markets versus secondary and tertiary markets. Now, I'm just talking about, generally speaking, like nationwide, you have primary markets, kind of the golden, you know, access points to the U.S. You think of Chicago, New York, San Francisco, you know, some of those places, Miami. And then you have secondary markets, which Charlotte might be considered a secondary market. But within your state, again, I'm in North Carolina, so within my state, Charlotte and Raleigh would be a primary market, secondary to some others who are looking nationwide or whatever. And it kind of goes from there. So a Cary might be a tertiary market to somebody else, whereas to me, that's more of a primary secondary market. So the point is these aren't hard and fast rules, but it's a way to think about the locations that you're looking to acquire facilities and who might be playing in that space. So I break it down like this into the 2x2 matrix. A lot of people like these things, so I kind of decided to go this way. So you have right here above 40,000 square feet, groups are looking for those types of deals. Below 40,000 square feet, groups are looking for those type of deals. And then here you have secondary, tertiary markets, primary, and secondary markets. There's a little bit of overlap in the markets. Yeah. So what that actually looks like is this, where in these, if your facility is about 40,000 square feet and above, or with room to expand, and you're in a primary market, there's gonna be a lot of competition there. And then the opposite, if you're under 40,000-ish square feet in the secondary, tertiary market, there's little competition there. And I wouldn't say little. There's less competition there. There's still competition. Yeah, I wouldn't say little by any means. So again, take all this with a grain of salt. These aren't hard and fast rules, but they are something that you got to think about. Okay, if we're going to jump into storage, or we're in storage right now and we're not making the numbers work here, maybe we should go here if that fits our business plan. Or if we're finding success here, maybe we can jump here and we can find some deals that might make sense for us in this space. But the key is obviously how you find those deals, which we'll get into. But so the primary takeaway is obviously keeping your cost. Oh, let me go back to this for a second. Cost of capital. So if you're here, you always want to keep your cost of capital as low as possible. What I mean by that is when you're borrowing debt, debt is what it is. It's kind of, I wouldn't say it's the same for everybody because it depends on, a couple of factors, obviously, from different lenders and all that. But it's generally, sub 5%, 4%, just depends on the deal size, et cetera. That's just what it is. On your equity side, that cost of capital, that cost of money can be different. It can be, usually there's an 8% preferred return given to investors. It can go higher depending on experience of the sponsor or the investor. If they're trying to raise capital from outside groups, it could be a 10% return, 12% return, which is some things I've heard of. So it just depends. Now, if your cost of capital is high, it's going to be very difficult for you to compete for those deals. If your cost of capital is very low, you can pay a little bit more for the deal and outbid people. So that's what I talk about with cost of capital.
Gotcha.
You want to try and keep that as low as possible, at least the cost of equity as low as possible, so that you can become more competitive in the marketplace. Again, I know that's not rocket science. We're not splitting atoms here, but I think people kind of forget that. And when you run into stuff out there, you're trying to bid on a deal, you can't make the numbers work, but somebody else outbids you and you don't know how they do it. There's a couple of reasons probably, but one of them could be their cost of capital. They can just outbid people. So strategy or takeaway, keep your cost of capital low and your expectations in check. So you don't want to go out there thinking, oh man, I just discovered something great and we're going to jump into it and find a ton of success. That may not be the case. You may not find a deal for, 6 months to a year or so. It could turn out that way. I know that I've had that experience. So it's not easy. But that's one thing. Another thing, obviously, to keep in mind. So we just covered the acquisition strategies. Let's jump into the acquisitions mindset now. So when it comes to acquisitions, I tend to think of it kind of like basically like a funnel. Whether it's, you could have a business doing a haircutting place, a barbershop. You want customers to come in the door. And those people who come in or call you or whatever, they go to your website, they see how much it costs for a haircut, they see where you're located, they see when they can schedule it. You have a certain number of people that just will visit the website, a certain number will actually make an appointment, and then a certain number that actually show up. And then you cut the hair and obviously you make the money. That's the funnel, and it applies in every business out there. Apple needs to sell phones. They look at how many customers they have, how many people actually buy a phone, how many people upgrade, how many they think they'll sell. They put their projections out there for all the analysts to pick apart. So that's kind of, how you want to think about it. So I want to get as many deals as possible into my funnel. I want to filter through those deals because a lot of them will not make sense, and then others will. And once those that will make sense or might make sense, you want to analyze them, take a look at the financials, run them through your financial model, and then go from there and make an offer on those that you make an offer on. Not everybody's going to accept the offer. There may be something that happens that makes it fall apart, makes that deal fall apart once you get into due diligence. But the point is you'll close a certain number of whatever that ratio looks like. So if you have 100 deals that come into your funnel, a certain percentage of those will close. And now you have a scalable business. So now, okay, if I get 100 deals, I'll close X. All right, so if I get 200 deals in my funnel, I'll close X plus 2 or, X times 2 or whatever that is. So now you have a scalable business that you can ramp up over time. That's kind of how you want to think about it. So leads that come in, direct mail, phone calls, brokers, filter, analyze, you close those deals over time. I think people kind of forget that obviously brokers are great. Used them several times in the past, nothing wrong with that whatsoever. But the key person you're trying to talk to is the owner. And there's different ways of getting to that owner via direct mail, direct phone calls, and obviously the broker will sometimes have relationships with the owners, and they already kind of know and trust them and like them. And they can say, hey, I have a buyer over here who's interested in your facility, and kind of go from there. So on the direct mail side, I've done this in the past where I've sent postcards via Postcard Mania, sent out letters There's different mail houses that you can use. And I think that's probably the most effective way to do it, is to actually not do it yourself. I've sat there and I've licked stamps and folded envelopes and put them in the thing, in the envelope, put them in the mail. That's really very tedious. And sure, you can sign every single one, and it's kind of a higher touch thing, but I don't think it's a really great use of time. The better thing to do is to use a mail house, like maybe Postcard Mania, or one that sends out like yellow letters or whatever to owners directly. Again, it also depends on the space you're playing in. Back to that 2x2 matrix, where if you're under 40,000 square feet, a letter might be better. That might be a better marketing strategy to reach out to owners. If you're over 40,000 square feet, you're probably dealing with a sophisticated owner who doesn't care about your letter for the most part. They want to just get the highest price as possible, and they'll contact brokers to list their property for sale. I found some really small deals in that small, under 40,000 square foot size, where they're willing to do seller financing, or they're willing to get a little creative on their deal. There's also more hair on it, is what they say. There's more issues usually with it. I remember I couldn't close one time because the owner commingled everything with all of his businesses, and I couldn't wrap my head around how much money the thing actually made. And I mean, there's no lender that will lend on that. It just wouldn't make sense. So anyway, so there's issues to deal with, but the smaller space, some owners will be a little bit more receptive to phone calls and emails, or letters. And then in the larger space, they're just kind of hit or miss. It depends on who you're targeting. You do have some mom and pops that own big ones. So there is some opportunity there. It's good just to stay in front of people. It's good just to, acquisitions is kind of like that opportunistic game, right? So somebody might not be ready to sell right now, but they're ready in 8 months. I remember talking to one guy who wasn't ready right now, but he was going through a divorce. He said, I'll probably be ready in like 5 or 6 months. So, then I called him, he wasn't ready still. So it's kind of, it's kind of hit or miss, but you want to kind of be there when that opportunity strikes. As far as phone calls, I've done this before many times, calling directly to owners. People think it can be a waste of time because it's not a great use. You can talk to brokers, they can find you deals, whatever. But I've actually found it to be very effective to figure out what's going on in the market. When you talk to an owner who may not be ready to sell, but they are willing to have a conversation around the industry and around their manager and around best practices, it's really interesting the information you could dig up when you talk to owners, and even talk to maybe the owner isn't there, but the manager's there, and they're there on a day-to-day basis, and you can talk to them, and they'll share a lot of information with you. As far as data is concerned, you can go to Yardi. They are really good with the acquisition data. If you go and you look at a deal, it'll give the phone number, address, always of the actual owner, not an LLC. And then if it's incorrect, they'll fix it, usually within 24 hours, usually less for me, 3-4 hours, and you get an email update saying, hey, this has been corrected. And that phone number will be their house, or to be their cell phone. It won't be like some phone in the office or whatever. The address will be their home address. So they're actually very, very good. They're also the most expensive, but the data is extremely good. Reonomy is another one. They're a little more broad, and that's kind of a good thing. But their packages, it's kind of been hit or miss for me in the past. I think they've gotten a lot better. I recently did a demo with them, and I think they've gotten a lot better with the data. So that's actually a positive thing. So Yardi is going to be very specific to storage. If you just want the storage data, they'll provide it. Reonomy is going to be a bit more broad, so that may not be for everybody, but it is an option, and a little lower on the cost as well. So again, this is around acquisition. So Radius Plus is great if you want to figure out, what the market's doing right now, feet per person, all that kind of stuff. Radius Plus, I think, is excellent for some of that. But I think these guys do a little bit better on the acquisition side, looking to talk to owners. So the biggest question, though, that you're going to get when you talk to an owner is, can you close? And that's the same thing with a broker. Can you close? Do you have the money? Can you close? Can you close the deal? And how long will this take? Those are the big questions. So check yes or no. Hopefully you have everything else. That's a whole nother topic for another time, but hopefully you have everything else on the back end taken care of, that you can actually close the deal when you talk to the owners and you have the capital in hand, and it won't be an issue. So key takeaway there: use data and brokers to fill your funnel with leads, filter those leads, analyze those leads, make offers, and close. Again, it's just wrapping your head around, we need to get as many leads as possible into our funnel, and then we got to close those leads that make sense, close those deals that make sense, and we can figure out a ratio and now we can up the outreach, up the marketing. We have a scalable business now. So that's basically the idea. So that's the acquisitions mindset, is understanding the market, understanding what's going on out there, understanding that it's hot right now. It's a little overheated, but that's okay, that you can find or use a strategy that might make sense for you, and then reach out and talk to people as much as possible, and get those leads into your funnel that you can close. So here's the summary of the 4 key takeaways. Again, why storage is hot: historically recession-resistant asset class. Storage in this cycle, more dollars chasing fewer deals, prices high, yields low. Acquisition strategies: keep your cost of capital low, understand what type of deals you're targeting, what type of owner that might be, how competitive you might need to get. And then again, the acquisitions mindset: fill your funnel with leads, filter those leads, analyze those leads, make offers on those leads, figure out what your closing ratio is, and now you have a scalable business, acquisitions business. So we didn't talk much about development, because I think that's a whole nother topic.
Yeah.
And it's not primarily my background either, but a little more risky, a little more capital involved. So I think some other folks can speak to that topic a little bit better than I could. But we wanted to focus on the acquisition side. So so that's basically it, guys. We'll appreciate it.
No, it's been great. This is a good topic. It kind of dovetails into some other topics we're covering on today's summit. So that's great session, Kris. Thanks so much.
Oh yeah, absolutely, Jim. I appreciate it. Thank you guys for being here and for watching. If you have any questions, comments, please reach out. You can check out the YouTube channel, the Storage Investor Show. Reach out to me on our website, and you can contact us that way as well. Especially if you have a deal you want to share, we'd love to look at that and go from there.
Oh, exactly. We'll put all your contact information here on your speaker page. So we'll make it easy for everyone.
Great.
Get in contact with you. And again, I want to give a special plug out to your YouTube channel too. It's great. Some great information on there. That's how I've kind of educated myself. This is something that I'm not in this world. I'm more of the operations, the management, and that kind of thing from the marketing end of it. So I've educated myself from watching your YouTube channel. So thank you.
Awesome. Thanks, Jim. Appreciate it, man. There's other great educators out there. I'm sure you have some others on. Scott Myers, who knows a lot about what's going on. Mark Helm. I mean, there's several others out there. So there's a lot of free content that people can get and get up to speed on the industry and hopefully find some success.
Yeah, I kind of assembled the all-star team for this first summit.
Yeah.
I don't know what's going on here.
Oh yeah. Very good. Very good.
Thanks so much, Kris. I'll see you next time.
All right. Thanks, Jim. Appreciate it.
Bye.
Thank you so much for listening to the Self Storage Show. Would you like some free stuff? Go to 3milestorage.com/free to find a list of items you can get for free that will help you dominate your 3-mile market. There, you'll find our free ebook, the Every Call Counts sales script, how to join our Facebook community, access to the next showing of the 3-day online summit, and whatever else we can think of to bring value to you and your self-storage business. So go to 3milestorage.com/free and enjoy.